Welcome to today's Market Snapshot. My name is Craig Erlam, Senior Market Analyst at OANDA. So far today we're seeing some risk aversion in the markets. We've got European equity markets about to close around 0.5% to 1% lower. US markets as well trading marginally lower, not quite as much as we're seeing in Europe. I think a lot of what we're seeing right now and what we could continue to see towards the end of the week is just an example of some risk aversion, some caution among traders due to the fact that we've got a number of key risk events to come both this week with the non-farm payrolls and obviously the overall jobs report, the ECB tomorrow, the OPEC meeting as well, a potential risk event for the oil markets. We've also got quite an intense month to come as well. Of course, they got the EU referendum in the UK on June 23rd. We've also got the Federal Reserve meeting just over a week before, at which point we could potentially see a rate hike. So there's a lot. I think there's going to be, like I said, quite an intense month. We are heading into the summer months as well, which can typically mean lighter volume as well. And I think what we're seeing today, like I say, is just that little bit of risk aversion because we've got so much to come between now and the end of the week. I think the main story really in the markets today, and which is where we're seeing the biggest moves, is in the Japanese yen. Now, we heard from Shinzo Abe earlier on today. He confirmed reports on Friday that the sales tax hike, which was due to take place earlier next year, has actually been pushed back now for 2.5 years to October 2019. This has been driven by the economy not necessarily performing as well as he's expected. He didn't suggest, well, he actually suggested this wasn't due to a failure of Abenomics. It's actually due to slower global growth, the impact of slow growth in China and slow trade in emerging markets, all of these culminating to actually hit the Japanese economy and necessitate the need for the sales tax hike to both be put back, but also for further fiscal stimulus measures to be put in place from this autumn. He didn't go into too much detail about these updating the rail lines and so on and so forth. That was one thing that rail lines was one thing that he did touch on, but he didn't go into too much detail on what the actual stimulus measures would be. But this has supported the yen so far today. We've seen it up around 1.6% against the pound and around 1% against the dollar. So seeing some decent gains here. We are also seeing the pound itself down around 0.5 percentage point against the dollar, and this comes off the back of some more polls on the EU referendum showing that the race is tightening up and it's much more neck and neck than it was say a week ago, and this is weighing on the pound so far today, and we could continue to see that occur if we do see the gap between the two closing over the next couple of weeks. So I think this again is going to be something to really focus on for the markets. Now today, like I said, we've had plenty of economic data. There's still plenty more to come between now and the end of the week. If we take a look at the economic calendar right now, we can see that here you go. We can see on the economic calendar that we've had some manufacturing PMI data already today. Mixed data really from the Eurozone, if not slightly weaker in some parts than we were expected. This also followed some relatively weak data from China as well on the manufacturing PMI front. The US PMI was slightly better at 50.7, which was a slight improvement on last month. The UK as well was a slight improvement as well, moving slightly back into growth territory, but all in all, really, these figures are quite disappointing. They do point to this continued weakness in global growth. This obviously just a report on the manufacturing sector, but really does just reflect this slowdown in global trade and the weaker global economic environment as a whole. We also had the ISM manufacturing PMI as well, which again, like the official reading, was better than expected. Some interesting aspects of that ISM report was the fact that, for example, while prices paid actually rose more than we were expecting, that row jumped up to 63.5 from 59. Things like the employment gauge remained at 49.2, but was weaker than expected. New orders also slipped slightly as well, although remained quite decent at 55.7. Again, all these factors do just point to pretty much the same thing, that we are seeing a tough global environment. Still to come today, we've got the API weekly crude oil stocks, but I think really now the focus is going to be on those three big key risk events this week. We've got OPEC meeting, which kicks off tomorrow. Of course, we've got the ECB meeting tomorrow, and even though we're expecting no change in monetary policy, it'll be interesting to see what the ECB actually has to say on the fact that the region does remain in deflation, and as of yet, any stimulus measures, albeit relatively new ones, given that they were only announced in March, do seem to be having minimal, if any, effect. And it'll be interesting to see again whether the door is open to more stimulus in the coming months. And then, of course, we've got the US jobs report to come on Friday. For more in-depth news and analysis, check out OANDA Market Pulse at MarketPulse.com. You can also find out more about OANDA and sign up for a free demo account at OANDA.com. Here you'll also get access to OANDA Forex Labs, which has a lot of great tools designed to help you with your trading.